Live from the Midwest, where cows become steaks. It's David Balin and Stephen Whiting, and you'll notice that today we are sitting in the same room. It's been 27 weeks that we've been separated, but now, by virtue of airlines, right, and an invitation to the Midwest, here we are.
Seems like the old-fashioned boardroom tables we used to sit at.
And what's really amazing is that this is a real table and not AI.
No,
Today, we're talking a little bit about the U.S. blockade of Iran and whether or not it's going to work. But what we've seen so far is that markets have not responded poorly to the idea of blockading Iran and to actually constrain the maximum amount of the oil price, which has not reached more than $118 since early in March. As we discussed probably 4 weeks ago, we thought that it was possible that there would be a path where markets would begin to adapt to where oil is. That supply of oil that is both in the ground and also now on the water will find its way to different places around the globe. And that even now, as prices have potentially peaked and we're seeing them come down some, the world is adapting. That does not mean that risk is off the table. That does not mean that the war will end well or that there won't be more disruption. But it does mean that markets are reacting in a relatively ordinary way.
So again, exactly as David just said, the fact that we have had a shock. This is not a bust, it's an interruption. Markets have conformed to the patterns that we've been talking about, that they tend to find their way back to the same level. Before all of the fear and all of the worry is over with, we have been talking about a crisis price for oil. The moment that a terrible shock occurs, when we know we're going to lose a commodity like gas or oil, the market will price more than the worst. And so that's what the 118 may be. But that part, I will say, is a maybe. The amount of time that it takes to get full trade back is still an open question, and there are some risks around that. But if you look at the next page, you know, what we did is we just showed you that the shipping is not back in the Straits of Hormuz. We're going to talk a lot about what oil supply looks like in the United States, what it looks like in other parts of the world, and how well we're prepared for some solution. It's certainly come via a very important pipeline in Saudi Arabia that's heading from east to west to the Red Sea, which has been really critical to keep the damage down in terms of the world economy. But it's interesting that the Trump administration has picked basically this blockade instead of trying to control the islands. It's having the same effect, and it's really raising the pressure for Iran to come some.
It is, and it is also avoiding having troops on the ground. So let's take a look at the next slide. So what we're talking about here is that the whole idea is when will the Mideast, energy trade, resolve? And for some economies, right, this is a huge impact, and for some, not as much of a huge impact. And one of the reasons why that's important is that its impact on the U.S. economy is different than it is, for example, in Europe, in Asia, and on the African continent.
And that's really one of the third point that we would talk about is how this resolves. Hard landing, soft landing for energy markets will really determine the relative performance of non-U.S. equities compared to the U.S. Now, we'll just talk a little bit about these stats. The left picture just shows for developed countries what strategic reserves look like. The U.S. looks a little bit better. It was climbing in its reserves. It hasn't come out yet, but we had really low levels of strategic reserves in Europe, for example, because of the war with Russia-Ukraine. But yet there are private inventories, including waterborne inventory, ships that usually weren't counted as inventory, filled with oil. And you can see that those private inventories are rather high in the developed world. Now, the next page would just go to the point that there are some real tough parts. Europe very normally fills up with gas before the winter. It just ran down all of that gas. So the gas that they would have gotten from the Persian Gulf is going to have to come from someplace else. Now, we're in this period right now where gas demand is seasonally low, but when it picks up in the future, hopefully that trade is back. The right picture shows some of the hot spots that India is terribly negatively impacted. Indonesia, the Philippines, and Africa are terribly negatively impacted by needing to find some supply somewhere else.
And this is not just impacting oil, it's also impacting the transport of fertilizer, rare earth metals, and other essential inputs. And it is interrupting manufacturing supply lines in a number of the countries Stephen just mentioned.
So on the next page, What we wanted to talk about is a little bit of the difference that we see in the US. The striking part, and this is a picture on the left that has a light blue line and an arrow pointing up, and that's what's happened to domestic production of crude oil in the US. And what that squiggly line that looks like a Richter scale is demand. Demand has been steady, supply has been rising. If we look at the right picture, private inventories again look quite healthy for crude oil. And it's as if we really haven't had a supply response. US producers have not even really moved up or down over this war so far, despite all of the big movement in prices. Now, the next page is where you would just see some of the things that have happened. And that is, and this is, we said most critically, is that we reached that, what we believe will be the crisis price, can't be absolutely certain, depends on duration, $118 a barrel. Traders have always been predicting that the price would come down because the straits would reopen. Well, we'll see some sort of elements of that. And gasoline, diesel, these things in the US are already coming a bit down in price.
Right. Now, we have seen a huge inflation shock in the Midwest, in the Midwest where we are.
Mideast.
And Mideast, right, and here. But inflation in the U.S. For March was reported at 3.3%. We think that may be a peak number as well. But the bottom line is it has had a real negative repercussions in the United States and stoking fears of inflation among consumers and causing a lot of poor consumer sentiment. But nonetheless, when we look at the U.S. economy in terms of how it is actually operating and the profits that are being reported, which we're going to talk about in terms of earnings reports for the first group of companies this earnings season, still continue to look relatively robust.
So we're going to show both consumer confidence, investor confidence in just a couple slides, but if we just take a look at the next one. The other element of this, and this is going to be very important, as to which assets perform well in the world. Okay, we believe that the whole world is not coming to an end. That's being pretty clear. It's going on in financial markets. Software shares up 4.5% today. But what's going on here, if you take a look at the left, is US natural gas exports, totally booming. The balance of trade on petroleum and products, the US imports some, it exports some, but that black line shows we've gone into an energy trade surplus. So if the energy price is high, it doesn't help our consumers, but it helps the broader economy.
That's correct.
And the producers in the economy overall. Now, if the price falls, it's going to help the consumers who have deficits in energy. And that was those red areas like India on that map we showed you earlier.
Right. And what has changed considerably, right, from the last energy crisis is that the U.S., right, was at a production deficit, right, during that crisis, and now is ability to actually generate already enough oil, but more importantly, to actually then produce and then deliver LNG, which is extremely important to Europe as they begin to refill their capacities. But again, as Steve and I have pointed out, this has been a very uneven impact to the global economy.
If you want to see the low point on production on that right chart, that black line, 2008 was the low point. Terrible time to have an energy shock. And people don't remember because the subprime crisis was so much bigger, but $145 oil because we weren't producing enough at that particular point.
Let's move ahead to the next slide. So what we want to also talk about is who is vulnerable or who are not. And we've seen obviously that the dollar, right, has risen in value. It's been going down for the last 15 months before the crisis, but now it's reversing as the trade balances, right, come back to the United States. The markets that are vulnerable, right, are much more about non-US markets in particular. They're recovering more slowly than ours are. But the idea that the markets can adapt is clearly evident in the data that you see right in front of us.
It was a story that we saw to the Ukraine invasion, again, where it seemed impossible for, Europe. That's what everybody thought. And suddenly they were able. China is a very interesting one where we're taking a look at the data on electric vehicle sales. And it was interesting that when the oil price went down so much, EV sales, which is almost half, a broader context of types of vehicles, but that are energy efficient vehicles, were about 50% of their fleet sales. Well, it started to go down because oil was so cheap. Well, now it's bounced back and probably has further to go. So China's not going to be that vulnerable to this. It has other issues. Right. Now, if you look at the next page, this is what we're talking about, that you've had this jump up in inflation expectations and you've had this terribly weak consumer sentiment. But the truth is that we've had weak consumer sentiment even before.
Yeah, what's been going on and actually getting worse, really, actually, since just before the president took office. during the election campaign, they talked about
And
how bad the
divisive
economy was,
issues,
which
these
it actually
things.
wasn't, and then the sentiment has gotten worse, and
Yeah.
obviously the stresses have. But what is very clear is that wages, right, for the average U.S. worker have not gone up appreciably, and costs definitely have gone up, of which now energy has been added to that. And so we see, between weaker employment data, right, and negative sentiment, this sense that things are worse actually than they are.
Yeah, the thing to think about, though, that a lot of people will be surprised on is that when we had that almost 1% rise in the consumer price index in the month of March, so you can call that 12% annualized inflation, we're about to see that number not go up, right? So it was really a discrete hit that we had on oil. We showed you earlier that energy costs are beginning to fall a bit. Now, how far that will go, how fast, whether or not the supply shock is going to be alleviated to get us down to where futures are. A nice 20% drop in crude oil prices is predicted over the coming year. If that happens, this can improve. So, investor sentiment. Now, you take a look at this on the next page. We just mentioned that Europe was able to adapt and people were very worried. I've been speaking to investors in Europe and they're really worried. That's a very good thing for returns. It's one of the reasons why we just added a little bit more to our equities in the region. What's been happening in the US seems quite akin to what we were, in a very milder sense, to where we were in April of last year. You look at that right picture, earnings were going up, share prices are down almost 20%. Here we are, earnings growing, probably 16% year to year in the quarter we just passed. And share prices fell as much as 9%.
That's right.
So where the earnings are going to go is going to matter for where the share prices are.
Right. So let's pause. You said something that we haven't emphasized, which is just this week we added 1.5% to our equity portfolio. Let's talk a little bit about where we added it.
So this is one of those rare times where we have all of our industry views, and we think that those, again, some of the large cap tech, some of the large cap software and healthware, these things are fine. But there's been a big correlation across all sectors. Energy going up, everything else had been going down. So we took and wanted to top off in a generalized way our allocations. A little bit more large cap US, Japan, Europe. And what are we giving up for this? We're giving up just a little bit of the bond allocation in some of the areas that don't have particularly high yields.
But what was interesting is that we said about 4 weeks ago that we would do exactly that if we saw some level of normalization in terms of the world's ability to adapt to the oil shock that is actually now in its 7th week. So let's take a look at the next slide.
Well, let's actually stay there for 1
Let's
second.
stay on
Sorry,
this
David.
slide.
We're in the same room. We always interrupt each other,
I know.
especially me. But you look at that left picture, and we were pointing out that this situation is similar and different to last year.
Right.
Now, you take a look at what the VIX did last year. That's that black line. So implied volatility had the 5th highest reading in all of history. So 50 years of data, and we were at you could count on one hand how many times it had been that bad. Share prices had fallen nearly 20%, and net bearish positions, that blue line, we had a lot of bears out there who were sure markets were going down. So there was this fear in the market, which gets everybody back in when suddenly it doesn't live up to expectations. We're doing that now in a milder way. You can see bearishness high, but coming down, implied volatility didn't reach something that was drastic, but all that correlation, 9 out of, or 10 out of 11 sectors going down is what we've been witnessing. That shows that there has been an interruption in markets. We want to take advantage of those dislocations.
That's exactly right. And of course, this whole idea about, how actually investors behave, I think is, indicative of the fact that, you have to look at the reality. The reality of the shock last year turned out to be far smaller, about 35% of what we thought it was going to be. And so far, this shock, which has been significant, is comparable in the actual size to what happened last year. But I think markets reacted much more rationally now as things begin to resolve.
They didn't overshoot to the downside, to be fair.
That's right. Now, I just want to point out, and we have to say this a second time, which is markets are presuming a resolution of the U.S. and Iran war by what the market's behavior is right now. And so are we. And there is risk associated with that. But again, that's where markets are as we move ahead. Next slide, if we can. So we've mentioned this a few times, and it's worth repeating, and I hope this will be the last time we have to repeat it, which essentially is that only twice, right, in the last basically 50 years have major global events had a long-term negative impact on markets. We talked about that. That's World War II and the oil embargo that took place in the early, what was it,
1974.
It's hard to believe I was alive then. But I was, and it was bad. And I actually remember at that time, like that you could only go to gasoline stations every other day.
I remember sitting in a car as a little boy. I was just a little bit younger than you, just a little bit, without any air conditioning on a gas line. That was a very bad memory of inflation shock in 74.
But you weren't in a Volvo, and I was. And there we have it, and that's what's going on. So that's what's happening with that. And so, again, this is not going to be that shock, barring anything unusual. Let's go to the next slide and talk a little bit about where we are portfolio-wise.
So the thing that isn't resolved is this energy situation. Is it going to take longer or less time? Is it going to result in a higher equilibrium price or the old one, or something along those lines? And that really is going to determine the relative performance of those energy consuming economies and markets that have a lot of growth in Asia, for example, but they need energy, or the United States, which has that growth, but also has a lot of energy. So if you take a look at the left picture, you can see, let me start with the one on the right. The monetary policy in the United States is really the thing that moves around a lot and determines the value of the dollar. But when we've had this energy supply shock, we were thinking about further rate cuts. Now, for a while, there was this view that the Fed might even have to make a tightening step. Now, that was probably not very plausible in our view, but markets priced in a little bit of tightening and the dollar shot up. As oil has come down, we've priced in again the possibility the Federal Reserve could focus in on employment. The dollar has come down. So oil has been an important near-term driver of the exchange rate. Now, we want to know what's always an important driver of relative performance in U.S. and non-U.S. equities. That's the exchange rate. You can see that consistent performance. If the dollar falls, non-U.S. stocks tend to outperform. If the dollar rises, it means that there's more optimism and more savings flowing into the U.S. market.
And if you take a look at our performance of our portfolio year to date, which is, in equities alone, which is now, 5%-ish, that actually is indicative of the fact that the international part was a very large contributor. Now the U.S. is coming back. If the dollar falls, we could have actually both the outperformance internationally and continued strong performance based on earnings here in the United States.
Even with the hit to non-U.S. equities, they've still outperformed in the year to date.
Exactly. So let's move to the next slide. And we'll talk a little bit about, what's going on now with the duration, of this tech boom. And what's important just is to talk about the enormous impact, that AI had on tech that has completely been taken out of the narrative until really the last 48 hours. So just to divide that up into a couple of things, we saw defense shares do extraordinarily well, and we sold some of those. We saw cyber shares crumble, which made no sense to us, and we retained that position. We saw an enormous decline of about 20 to 25% in the typical software shares across the marketplace as a result of fears that AI was actually going to destroy those businesses. And it continued, I would say a flat line and now a slight uptick to hardware sales. But the bottom line is that earnings in technology continue to rise disproportionately.
This is supposed to be a sector that will probably raise EPS 40% this year. Now, how is that going to be possible? That's with semiconductors up 88%. That earnings estimate might slightly be a stretch, but when your growing revenue in data center building is going up 50%, the chance of just pushing margins even higher when you're sold out, it's going to be a very strong year for tech EPS. The question is the years beyond. Now, the right picture is the one that we come to and say, well, wait a second, if we're replacing labor with AI, if we have had a slowing in the labor market in the United States going all the way back to 2021, and it doesn't turn around quickly, the Federal Reserve will be in the business of easing again. It doesn't have to be a lot, maybe 50 basis points before the Fed really pauses for good. If they don't, maybe they'll cut even more. But what we're at is we're still at a level of the US dollar that's 12% inflation adjusted above its long-term average. And that's, again, the reason why if we resolve this issue of the energy shock, we've had 15 months of outperformance of non-US shares. Prior to that, 15 years of US outperformance. And that's what got you to that very high tech share. So we're constantly balancing. We like tech now. We think it'll probably still be strong, but we have to be very careful about how far the boom can go. And on the non-US side, we don't see boom-like assets. We see 13 times forward earnings. It's never going to be the same growth rate as the United States. It doesn't have to be.
Right. And that's why asset allocation matters so much, and why I think we're leaning into equities at the moment, and why also we're maintaining, a very strong exposure to the tech sectors and specific subsectors in that area. Next slide. So before we finish, just take a look at the fact that now it's been 2 years prior to this that we've seen a boom in tech EPS. We're seeing those growth rates and earnings actually accelerate further this year. And during some of our conversations with our Wellington partners, we see that that's going to continue out into 2027 pretty considerably, with more companies telling us they're going to spend more on AI. And for the first time in the last 2 weeks, enormous revenue boosts for both OpenAI and Anthropic in terms of the rate of growth of use of AI and of the amount of money being spent in terms of annualized revenues associated with the purchase of tokens, which is how you actually use AI. And that now, just as an example for both companies, is each of them running at a $30 billion rate, the fastest growth of any company that we've seen ever in terms of the speed of revenue acceleration, far beyond names like Palantir that were doing extraordinarily well before this.
And now the other thing that came out is the AI threat to cybersecurity. And again, another one involving Anthropic. And suddenly, again, we're having meetings about cybersecurity with the Federal Reserve and Treasury Secretary and large banks thinking about what the threats could be on cyber. But hey, those shares are only down 20%. So what that right picture is showing you is that we're at the lowest relative performance for software compared to hardware since the boom of the year 2000. So this is one of the reasons why, with that type of backdrop and mid-teens EPS growth with mid-teens declines in share prices, we still want to stay overweight software and cyber.
Next slide, please. So when we take a look at our asset allocation, as Stephen mentioned and I mentioned earlier, right, we've increased about 1.5% our exposure to equities in the US, Europe, and in Japan. We've taken that small amount out of our bond portfolio to do so. What that implies is that we're expecting to have a positive resolution, hopefully a peaceful resolution to the war. We expect that as markets normalize, we're going to see continued growth in the US. We're going to see Europe normalize and Asia get back to its relatively strong growth rates. And we're thinking that by the time the end of the year resolves, we may have the economy sort of moving normally in terms of energy supplies and ultimately in terms of production. If that turns out to be the case, what we're going to see, I think, is a continued acceleration of earnings in the US from 26 to early 27. And again, as I mentioned, a normalization elsewhere. With that and the weakening labor markets that Stephen's talked about, we are expecting that the Fed will ultimately have to address lower employment in the United States. With that, with rates coming down, we could imagine the dollar falling, making foreign shares more attractive to U.S. investors. But what Stephen said about 10 minutes ago, which is that it's the balance of portfolios that matters most now, that's where we spend our time, picking what fixed income assets to have, what equities to have, how to actually build resilient portfolios, paying attention closely to the activities in the market and what energy markets and energy futures are telling us. And to some extent, Stephen, ignoring some of the sentiment, because the sentiment is much worse than the actual economic impact so far that the Iran war has had in terms of the U.S. economy.
Oh, it's been a rough time. It's difficult to buy when there's a lot of risk and fear, but it's usually the time that does pay off. I would imagine that the return in the S&P 500 over the balance of the year, if this does work out, if the war is not an endless one in terms of cutting down supply, it's probably an 8 to 10% return over the balance of the year. That's not as great as the 35% jump that you had last year after the 20% sell-off, but that still, again, warrants, a full allocation. And we wanted to make sure that in addition to our thematic equities, where we think there's a bigger opportunity like cybersecurity, that we also have a full allocation to broader equities.
So thank you so much for joining us. It is our 27th week of producing this extraordinary program. We want to thank Adam and Abe and Sean and Mary, who are back at the home office in Charleston, South Carolina, and Rumson, New Jersey. And if you haven't been to Rumson yet,
It's a beautiful place.
Beautiful place. Have a good day.